What's up, guys? If you've been around a while, you know how much I love the wheel strategy. Probably my favorite strategy to do with options. I've made hundreds and hundreds of videos about it. The thing I get asked most about on this YouTube channel. But what you might not know is my most viewed video actually has to do with LEAPS options and the poor man covered call, which leads to another question I get asked all the time. What's better? Is it the wheel strategy, selling calls and puts to collect premium? Or is it LEAPS options where we're going to buy options and then possibly be able to sell some calls against them and do the poor man's covered call? And especially now in this market, right? People don't just call me like, hey, Brad, what's better, the wheel strategy or LEAPS? Like, that's ridiculous. But now that the markets are trending downward, they want to know, hey, Brad, are you still doing LEAPS? Are you still doing the wheel? What the hell's going on with this crazy market? So I want to dive down. I'm going to show you all my LEAPS that I have open, all the things that I'm wheeling right now, the pros and cons of both, and kind of like how I'm moving forward through this market right now when it comes to the wheel strategy and LEAPS. I do just want to pause for the people that have been around for a while and all the people that are going to be here in the future. No, this is not a sponsored video, so there is no ad. I just want to thank you from the bottom of my heart. All right, I just got this in the mail. I just reached 100,000 subscribers earlier in the month, and I cannot tell you how humbling it is. I didn't do a live stream or anything. I hate being the center of attention, if I can be completely honest, but I did want to take a second and just tell you from the bottom of my heart, I'm getting choked up just thinking about it, how much it really means to me. And I've been waiting for that piece of wall art for a really long time, 5 years. I've worked really hard for it, so thank you. And I figured, why not do a wheel strategy or an options video? That's kind of what put this channel on the map. And like I said, I'm a bumbling fool. I can babble and babble about it. I really thank you guys. Thank you so much. And the people that have been around since Baby Steps Brad in the early days, you know who you are. Thank you. And you guys mean the world to me. And I enjoy sitting down at this computer every single day and doing videos like this and getting them out and sharing, and the community and the best friends that I've made throughout this journey. You know, that I can't put a value on that, right? I have some of my best friends, I think, that I'll have for the rest of my life because of YouTube. And this is just a vanity thing. It is, but it means something to me, right? Maybe it doesn't mean something to you, but it means something to me because it shows how much you guys care about me and how much we've learned from one another over the last 5 years. So I'll get back to the video now. Thank you. Thank you so much. So let's start with the wheel. The wheel is actually where I started my options journey, and I think that's because at first I felt like it had the lowest amount of risk, right? And I was getting money. I didn't have to pay any money to actually perform this options task. And when I say the wheel, all I'm saying is that we are going to write cash secure puts, or we're going to write covered calls. And then when one of the two gets assigned, we're just going to do the other. So we're going to either start with a cash secure put, and then when it gets assigned, do a covered call, or vice versa. And if you want to know like the ins and outs, like this is not an ins and outs of the wheel. All right. I've done many videos about it. I have like a little ebook journal that you can get if you're inside my Discord or other links. But if you just have a general idea of selling options, what a strike price is, what a expiration is, what premium is, then this video, you'll be just fine. The pros, like I said, you're collecting money, right? You get to hold shares. If you're doing covered calls, you get the premiums when you're holding those shares. There are a lot of good pros, and really the only big con that I see with the wheel is it does take a lot of upfront capital to do this with a quality stock and a stock that you want to hold long term. This is not something you can really do with a crappy stock because you're just going to get smacked. So like I consider like most good stocks start to come in $35, $40, and you need to own 100 shares or have the cash available to buy 100 shares of that security. So the barrier to entry, that $3,500 to $5,000 kind of range, is kind of crappy. But there is a silver lining, right? While you're saving up money or while you're earning 100 shares, you could be learning. Maybe this is part of your process. Good. That's kind of what I did, right? I picked one stock I wanted to use. I started with Wells Fargo way back in the day. And as I was just buying shares of Wells Fargo over and over again, I started to learn, everything I could about the wheel strategy. And it really was that barrier to entry that led me into learning about other option strategies like LEAPS, okay? We'll get to LEAPS in a second. I just want to show you the things that I'm wheeling because I think right now in this market, I like the wheel better than a LEAPS option. All right. I like the fact that I can write cash secure puts on stocks that have taken a smack and now are at a really, really good volume, really good value. And I could, pick strike prices way below what I think companies are worth. And with this volatility and stocks continue to move downward, I can really take advantage of high premiums because of that high volatility. So as I'm seeing these quality stocks start to dip, I'm really, really starting to think about deploying capital into them and starting with the cash secure put. I personally don't know if I would start with buying 100 shares and starting on the call side, like I said, because we really don't know what's going on. The market's trending downward. And is it going to reverse tomorrow? Who knows? But we have to kind of go with the winds of the market, and the winds of the market are kind of down. They're kind of bearish. And until they start to reverse themselves and show confirmation that we're ready to go back up, I'm not really looking to buy shares and allow them to go down and take a capital loss. So what I'm going to keep doing is I'm going to keep writing cash secure puts lower and lower and lower. And if I get a sign, then I'll do the call. But I like to keep conservative deltas with my cash secure puts anywhere from like 0.2 to 0.4. Right, I'm going to put those in there, or I'm just going to pick a very, very good value of a stock. And we'll see it here. Sometimes I have a stock that I thought was a great price and is just blown through that. And this maybe will be a little bit of that Peloton update that people were curious about in March, but it's okay to get assigned, and it's okay to get assigned and the stock continued to crash further. For me, that's just another opportunity to buy a cash secure put. So inside Robinhood, we can see, guys, here are the 1, 2, 3, 4, 5 stocks that I'm wheeling. Google, I am not wheeling just yet. I did do a video about it. If you know, they have a 20-to-1 stock split. So I have 5 shares of that. People have been asking about Amazon. I'm going to make an Amazon video of why I'm not buying 5 shares of Amazon. And I did buy 5 shares of Google. It's pretty much just an evaluation thing. I think Google is a good deal right now. I don't necessarily think Amazon is a great deal. But we have HPQ right now. I have 100 shares of that with an average price of $36.41. So that just means I have to write calls above $36.41. VTI, I just love holding VTI, Total Stock Market Index Fund. This is a very, very expensive wheel for me. It's 22 grand. I pretty much wanted to trade it for 6 months and see what kind of returns I could get on top of market returns. I'm almost done with that 6 months, so there'll be a video just on VTI. But I definitely think with the 22 grand that I put in to do the wheel at VTI, I could break that up into 4 or 5 other stocks and really increase my wheel list. Intel, one of my favorite stocks. I think they're an incredible value and they just keep going down. There'll probably be some more cash secure puts. Camping World, I love Camping World, and they just took another big drop. If we look at them over the last 3 months, they just been on a downtrend, down 23%. And actually, when I got these 100 shares and when I wrote this cash secure put, I moved this over because I've been bouncing around accounts. I think my basis on this is $40. So for me to get it now at $22, $23, I can write puts on that all day. And then here are some other ones that I'm wheeling as well. Walgreens, Cisco, Aflac. These are just ones that I'm watching and waiting for proper entry. Now, I don't have a lot of calls on them right now because I only write calls above my basis. And frankly, with all the red, there's not a lot of opportunities to get some premiums for writing calls above my basis. I could gamble, go a little closer to the money, but I'm not willing to take that gamble. So that is another con of the wheel strategy. If the stock goes down a little bit and you can't write calls above your basis, you're going to be bag holding. That's why you need to do it with a quality stock. I don't mind holding this. I don't mind holding any of these stocks, especially because I like to do them with dividends. So at least, worst case scenario, I'm going to be getting the dividends while I wait for the price to recover, and then I can write some calls. This Peloton put, guys, I've been battling with that since the first dip of Peloton. This actually started as a $60 cash secure put. And I've been rolling it because, as we know, Peloton just keeps diving. And I just rolled it again. I'm actually up on this position. So if you saw the Peloton disaster, I'm still up on this position, okay? Even with a strike price of $40. Every single time I get close, I'm able to roll it down $5 and not take any more of a loss. If anything, I'm able to roll for a credit. So I'm pretty much rolling it out every 3 months. Now I got to hold it till July. And everyone's like, yeah, well, you have to hold this stock. Or you have to hold this contract. Yeah, I have to hold the contract. It's no big deal. I understand that. And all I have to do is keep rolling it for a credit or a very small loss. And then one day, if Peloton ever recovers when their shops start to open or they figure some things out, I'm going to now be in a position where if this expires worthless, right? How much did I pay? $836 was the average for this, okay? Right now is a market value that's higher than that, but if this goes worthless, I'm up to make $836. So even if I have to hold this and roll this for a year, that's gonna be fine. My position is that one day Peloton will probably be back above 40, or if I need to roll it a few more times and get it down to 30, it's at $20 right now. If you look at the last month, guys, like I said, it's just been a bloodbath for them, right? The last 3 months down almost 50%. So do I think that they'll ever recover back up into the $30 range? I frankly do, and maybe I'm a donkey, and maybe I'll put my foot in my mouth, but I'll continue to roll Peloton because I thought it was a great price at 50, and I think it's an even better price right now. I think they just caught a string of bad luck, bad timing, and they were a little hyped up because of the COVID stuff, and like people were working out more at home. I understand they were probably a little overvalued, but I still kind of like Peloton at $20. I really do. Guys, if you do want to get your hands on this, it's like 75 pages, it's $5, and you get access to the Discord if you want it. I'd be a donkey if I didn't like at least plug my own stuff, but if you don't get it, it's $5. I don't really care. $5 is pretty much the cost for me to print it. No big deal. All right, now let's dive into LEAPS. Long-term equity anticipation securities. Please do not forget the S when you comment down in the comment section below. It'll show me that you did not watch this part of the video, and I will probably respond with,
I'm sorry, I don't know what a LEAP option is.
well, the S does not make it plural. Feel free to go around to all the YouTubers that make LEAP option videos and let them know that the S is part of the acronym. It is an enormous pet peeve and a red flag that a person has no idea what the hell they're talking about. Rant over. I'm going to get off my soapbox. It's LEAPS, guys. Long-term equity anticipation security. Okay, what does that mean? That means we're going to buy an option, a call or a put, that's going to be a long time expiration, generally longer than a year. All right, and I love this option because it allows you to buy essentially a leveraged amount of shares for a fraction of the amount of price according to the delta that you choose. The further that you go in the money, okay, the further away you go from the share price, the delta on that is going to rise. Now, what is delta? Delta is how much the value of the option is going to increase with every dollar of the share price. For example, I love to write my LEAPS at a 0.7 delta or better. So if you have a LEAPS option that has a delta of 0.7 and that share price goes up $1, the value of your option is going to go up 70 cents or $70 because the contract is 100 shares. So this is where people say it's like owning 70 shares, right? Because if you owned 100 shares and it went up $1, then you'd get a $100 profit. That would be almost like a delta of 1, right? If I had a delta of 99 and it went up $1, the value of my option would go up 99 cents or $99. So it's actually the same as owning 99 shares. So you're essentially going to get 70 shares of a stock for a fraction of the price.
But Brad, if the stock goes down, right, we get nothing. We lose all of our premium, where if I held the shares, you know, I would get to just bag hold them and it would recover.
And that's absolutely true. You're going to see in a second, all my LEAPS are just getting annihilated, right? Most of them are worthless. And at the end of that expiration, if I just ended it all and said, yep, I lost all my money and then I never reinvested back in that stock, you're absolutely right. I would lose all my premium. But if it goes down, and at expiration, I still think it's a good price, what can I do? I could buy another LEAPS, and just like you'd have to recover with the share price, I can recover with the profit of a LEAPS. It's not that hard to recover on your losses. Also, it's worth noting, if you own 100 shares, that stock price can go to zero. You can lose an infinite amount of money to zero. If you own a LEAPS option, you can only lose the premium that you put in. So it's actually a little downside protection when you own a LEAPS. People always want to debate that it's not as good as owning 100 shares, and that's fine. If you're intimidated by options and you don't want to buy options, then don't buy options. But don't go out and say that, you know, holding shares is better than holding a LEAPS. It just depends on what your strategy is. The other thing that makes a LEAPS really good is that you can turn it into a diagonal calendar debit spread, meaning that after you are holding this LEAPS option, you can write a covered call against it called the poor man's covered call and collect premium, lowering essentially your adjusted cost basis on the premiums that you've paid. Let's say you get a LEAPS and it costs you $1,000 for that LEAPS, and over the year that you hold it, you can recuperate $500 in covered calls against it. Now that LEAPS only costs you $500. So the ability to do the poor man's covered call, which is my most viewed video, is really the beauty of the LEAPS option in my opinion. Now I have a couple of LEAPS options that have been open for a while. None of them really look good. Here's where we're at. I have a Microsoft March 18th, been holding on to this one for a while, and it is down 99%. It is worthless. All right, I'm going to most likely lose $1,600. I might have collected a little bit of premium, definitely not $1,600, but I'm going to lose on this trade. Okay, definitely going to lose. TQQ, I have 75, same, March 18th. I'm going to lose another $1,800 there. Son of a bitch. I have a Tattoo Chef LEAPS. I'm down at 95% in that one. Smack, smack, smack. Starbucks. They just got hit again today, right? Didn't they get Starbucks smacked today? Let's see, wait. I'm telling you, guys, and I'll tell you why I'm laughing about it in a second, because it's really not that funny. Yeah, they're down 30%, but what were they today? They were down only 5% today. Okay, so my Starbucks leap, yikes! All right, getting smacked. This Vuzi, oh my gosh. Once upon a time, this Vuzi option when I was holding it was worth $2,000. Pretty awesome. I bought it for $400. It was once upon a time worth $400. Now it's worth $200. All right. This one I have sold a bunch of calls on this, and I think I'm even, or my basis is 0. And then I have a Facebook call for next year. Okay. And this is the example of what I was talking about. I had a Facebook call option that expired 2 weeks ago, and it was a LEAPS. And with what happened with Facebook, it went to 0. What did I do immediately? I got myself another one for 2023, March of 2023. So now I have this year. Now it's down 60% because the market keeps trending downward, but I have over a year that I can recoup this. And I've already started selling calls against this, lowering that 3,152. So that Facebook, I'm not that worried. I took a big loss on the first LEAPS. I might take a big loss on this one, but I'm a continued investor. Just like if I own 100 shares, I'm holding long term. My plan is to keep selling LEAPS every single year on Facebook until I'm good to go. Now, why haven't I done that with Microsoft and TQQ and Tattooed Chef and Starbucks yet? Well, because of learning my lesson after this one, then I'm just pumping the brakes. Like I mentioned before, I'm waiting for the market to recover, start to trend back upward. That's where I'm going to get back into the LEAPS options. Brad, but couldn't you just buy LEAPS puts? Yes, you absolutely could. I've never been one to bet against any company really on the long term, and this is what that is. If you watch my day trading videos on my other channel, Brad Finn Day Trades, you see I love buying puts and profiting in a day trade kind of standpoint. But historically, guys, the market goes up. And even with this last couple months, right, it's not even that bad, guys. I know people are like freaking out. If we look at the SPY over the last year, the SPY, you're up 6%. All right. The market historically returns what, between 7 and 9%? It's not that bad. The market was extremely overvalued. So it's not that bad. It'll turn around. It'll be fine. So because of that, I don't really want to buy puts, right? I don't think that this downtrend is going to happen forever. I don't even know if it'll happen for a year. I think it could go 6 months. I think we still have a lot of overvalued areas inside the market that could continue to sell off. We still have a lot of things going on in the news. That's why I'm not buying long-term calls, okay? The put side, like I said, I'm just not comfortable against betting down, right? I would rather hope that the market's going to recover and do what it's done historically and go up than have to hope that it continues to go down. I don't want to bet against the market. I don't want to bet against companies. I just think that's like bad karma. So you could do LEAPS with puts. I just personally don't. At the end of the day, the wheel, I think right now in this market is a little bit better, right? We can kind of choose our entries, choose our prices, choose our basics and our strikes. I think that's why I'm going back to the wheel strategy a little bit more. I'm also being a little bit more YOLO risky with the day trading stuff, which I believe buying options does have a little bit more risk. The long-term part of it, the fact that it's expiring so long, is in our favor. As a buyer, we like to have time. So I don't think you're going to see too many LEAPS from me right now, just until we see the market kind of recover, and we'll go back to the wheel, back to the bread and butter. But I think even when everything was great and the markets were up all day, I still had a balance of both, right? It's okay to do both, but you don't have to do both. I did the wheel for 3 years before I ever bought a call option on purpose. All right. So just know that, like, don't compare my 7th year to your 1st week or your 7th week or your 7th month. Do what's good for you. Hop in with communities, get with a group of like-minded individuals, ask questions, right? Whether that's my community in my Discord or somebody else's, ask questions. That's how I learned, by asking questions almost to the point where I was a pest. And please, I beg you, do not leave off the S in LEAPS. Don't do it. I'll catch you guys on the next video.